In the world of finance, few topics elicit as much fascination, concern, and curiosity as stock market bubbles and corrections. From the roaring highs to the nerve-wracking lows, the dynamic dance of the markets has shaped economies, fortunes, and dreams. Hello, and welcome back to Smart Finance HQ. Today, we're delving into a topic that has intrigued and sometimes terrified investors for generations: stock market bubbles and corrections. In this video, we will explore the differences between a correction, crash, and recession. We'll discuss how to recognize warning signs, examine real-world examples, and provide insights on whether you should fear or seize these market events as opportunities to invest. But that's not all. We'll take you beyond the headlines, sharing insights and actionable strategies to prepare for the unexpected, and ultimately, how to thrive amidst the chaos. So, stay with us, because by the end of this video, you'll be equipped with the knowledge and confidence to conquer the unpredictable world of finance. Let's begin. To start, we must ask ourselves, what is the difference between a correction, crash, and recession? A correction, crash, and recession are terms often used interchangeably, but they carry distinct meanings in the financial world. A correction is a natural part of the stock market cycle, representing a short-term decline in stock prices, usually around 10% or more from their recent peak. Corrections serve to correct overvaluation and reset prices to more reasonable levels. They can be triggered by various factors but typically recover relatively quickly. A crash, on the other hand, is a sudden and severe decline in stock prices, often greater than 20% in a short period, typically a day or a week. Crashes are typically unexpected and can be triggered by economic crises, political instability, or unforeseen events. Crashes can be the start of more prolonged economic downturns. A recession represents an extended period of economic decline, characterized by a decrease in gross domestic product, GDP, rising unemployment, and reduced consumer spending. While a stock market crash can often precede or coincide with a recession, the two are distinct, and not all market crashes lead to a recession. To be well prepared for market corrections, crashes, or economic recessions, it's essential to recognize the warning signs. Firstly, keep an eye on valuation metrics such as the price-to-earnings ratio. High PE ratios can indicate overvaluation in a market that might be ripe for a correction. Secondly, monitor market sentiment, as extreme optimism or pessimism can indicate a potential market shift. Investor sentiment surveys, like the American Association of Individual Investors Sentiment Survey, can provide insights into market mood. Thirdly, stay informed about economic indicators, including unemployment rates, GDP growth, and inflation. For example, an increasing unemployment rate and a declining GDP can signal an impending recession. And lastly, pay attention to geopolitical events, as they can have a significant impact on markets. For instance, trade disputes, political unrest, or international conflicts can lead to market instability. Now that we've established a solid understanding of the differences between stock market corrections, crashes, and recessions, as well as how to recognize warning signs, it's time to delve deeper. Real-world examples from the annals of U.S. financial history can provide invaluable insights into the actual impact of these market events and help us appreciate the behavior of financial markets in the wake of such crises. Let's take a look. 1. The Great Depression, the 1929 stock market crash, often referred to as Black Tuesday, remains one of the most devastating financial events in history. After reaching record highs in the 1920s, the stock market collapsed, leading to the Great Depression. The Dow Jones Industrial Average plunged from its pre-crash peak of around 386 to a mere 41.22 by July 1932. This precipitous drop wiped out substantial wealth, resulted in mass unemployment, and led to widespread economic hardship. 2. Dot-com bubble. The late 1990s and early 2000s witnessed the rapid rise and subsequent bursting of the dot-com bubble. This bubble was fueled by the excessive speculation surrounding internet-related stocks. Companies with little or no profit were awarded sky-high valuations, leading to a market correction. The Nasdaq Composite Index, primarily composed of technology stocks, fell by approximately 78% from its peak in March 2000 to its trough in October 2002. Investors who had poured money into overvalued tech stocks experienced significant losses. 3. Global financial crisis. The global financial crisis of 2008 was triggered by the subprime mortgage crisis and the subsequent collapse of Lehman Brothers. The crisis led to the Great Recession, with a severe impact on both the US and global markets. The S&P 500 lost roughly 50% of its value, and countless investors saw their portfolios significantly depleted. 4. COVID-19 pandemic. The COVID-19 pandemic, which emerged in early 2020, led to a sudden and steep market correction. By late March 2020, the S&P 500 had declined by approximately 30%. However, the market's resilience in the face of adversity was notable. Swift government stimulus packages, near-zero interest rates, and central bank interventions played a significant role in supporting the recovery that followed. Understanding how markets behave following these events provides us with a crucial understanding of the different scenarios that can be created after such events occur. The aftermath of the 1929 stock market crash was characterized by a prolonged period of economic hardship and market recovery. It took years for the market to regain its previous highs, and government intervention through the New Deal was instrumental in stabilizing the economy. After the dot-com bubble burst in the early 2000s, markets eventually rebounded. Investors who remained patient and diversified their portfolios witnessed their investments recover over time. Quality technology companies survived and thrived, ultimately contributing to market gains. The recovery following the 2008 financial crisis was similarly protracted but ultimately led to new market highs. Government bailouts and central bank actions were essential in stabilizing the financial system and spurring recovery. The pandemic-induced market correction in March 2020 was steep but followed by a rapid recovery. The combination of government stimulus, low interest rates, and increased investor confidence resulted in a strong rebound. These examples demonstrate the resilience of financial markets, emphasizing the importance of a long-term perspective. Investors who maintained their composure and adhered to diversified, well-thought-out strategies often experienced significant recoveries, highlighting the potential opportunities that can emerge after significant market corrections. Having explored these remarkable historical events, we've gained a wealth of knowledge about how the markets respond to adversity and eventually find their footing. Now, let's transition into the next part of our video, where we'll tackle the critical question. Should stock market crashes and corrections be approached with fear or seized as opportunities? We'll discuss different perspectives, strategies, and the potential for growth and recovery. So, let's dive right in. The question of whether to fear or seize stock market corrections and crashes as opportunities hinges on your perspective and preparedness. Many investors, especially those with limited experience, may naturally fear market downturns due to the potential loss of wealth. This fear can lead to panic selling, where investors realize losses and miss out on the eventual recovery. It's important to acknowledge that market volatility can be emotionally taxing. Savvy investors, on the other hand, view market downturns as opportunities to buy quality assets at lower prices. This perspective aligns with Warren Buffett's famous advice: be fearful when others are greedy, and be greedy when others are fearful. A long-term perspective and a well-structured investment plan are instrumental in taking advantage of market opportunities. Moreover, adopting the view that market corrections and crashes present investment opportunities can lead to benefits like lower average purchase prices, potential future gains, and a more resilient portfolio in the long run. As we navigate the nuances of how to approach stock market crashes and corrections, you may be wondering what practical steps can be taken to ensure your financial well-being in such challenging times. So, let's gear up for the part where we empower you with the tools to secure your financial future in the face of market uncertainty. 1. Diversification. Diversify your investments across various asset classes, reducing risk and potential losses. A diversified portfolio can include stocks, bonds, real estate, and commodities. 2. Emergency fund. Maintain an emergency fund to cover essential expenses during financial hardships. This ensures you won't be forced to sell investments at unfavorable times. 3. Long-term perspective. Focus on your long-term financial goals and avoid reacting to short-term market volatility. Many investors have benefited from holding onto quality assets through turbulent times. 4. Continuous learning. Stay informed and educated about financial markets, economic trends, and investment strategies. Understanding the fundamentals can help you make more informed decisions. 5. Asset allocation. Define a suitable asset allocation strategy based on your risk tolerance and financial goals. Rebalance your portfolio periodically to ensure it aligns with your desired asset mix. 6. Stress testing. Conduct stress tests on your portfolio to evaluate how it might perform under various market scenarios. This proactive approach helps you gauge its resilience. 7. Review investment goals. Regularly reassess your investment goals and make adjustments as your circumstances change. Are you saving for retirement, a down payment on a house, or a child's education? Understanding your goals will influence your investment strategy. 8. Alternative investments. Explore alternative investments, such as real estate, commodities, or even less traditional assets like cryptocurrencies. These can provide diversification benefits and potentially mitigate the impact of market downturns. 9. Professional guidance. Consider consulting a financial advisor who can help you tailor a comprehensive financial plan and provide guidance on risk management, tax-efficient strategies, and investment opportunities. 10. Mental resilience. Develop mental resilience as an investor. Recognize the emotional challenges that come with market volatility and prepare yourself to make rational, long-term decisions rather than reacting impulsively to short-term fluctuations. 11. Income streams. Build multiple income streams to reduce your reliance on your investment portfolio during tough economic times. This can involve side gigs, rental income, or passive income investments. Now that we've armed ourselves with strategies to fortify our financial position, it's time to shift our focus to the practical art of navigating stock market bubbles and corrections as an investor. So, stay with us as we delve into the real-world application of these strategies. Given the cyclical nature of financial markets, it's important to be prepared for potential bubbles and corrections. Here are some key tips. Firstly, regularly review your investment portfolio and rebalance it to ensure it aligns with your financial goals and risk tolerance. Secondly, implement risk management strategies, such as setting stop-loss orders or using trailing stop orders. These can help limit potential losses and protect your investments. Lastly, stay calm. In times of market turbulence, avoid making emotional decisions. Having a well-thought-out investment plan can help you stay focused on your long-term objectives. Avoid panic selling, as it can lead to realizing significant losses. In conclusion, stock market bubbles and corrections are integral parts of investing. Understanding the differences between corrections, crashes, and recessions, recognizing warning signs, and implementing sound investment strategies are essential for navigating these market events with confidence. Remember, historical market events are not indicative of future performance, and past market behavior does not guarantee future results. Consult with a financial advisor and conduct thorough research before making any investment decisions. By staying informed, maintaining a long-term perspective, and being prepared, you can better navigate stock market fluctuations and make informed investment decisions. Thank you for watching, and if you found this video helpful, please like, subscribe, and share it with others who may benefit from this valuable information. Stay tuned for more insights on personal finance and investing.